Hello, good morning and welcome to this edition of the Buy Now, Sell Now right here on ET Now. I'm Cheryl D'Souza and let me take you through the top headlines that we're tracking this Monday morning. And first up, let's talk about what the markets are doing. It's an expiry week. The Nifty is hovering around 11,500 mark. The techs are the ones that are leading the up move in today's trading session. And talking about tech, it is HCL Tech that is in focus as a top gainer on the Nifty. It's hit its record high level. They've gone ahead and the Australian arm is going to acquire DWS. The management is saying that the synergy value of working with DWS is very high. They're also saying expect to capture higher market share in the digital services. Let's shift focus now to another company that actually listed on the bourses today, and that is Route Mobile. Doubled on listing. It listed at 105% premium over the issue price. So another new listing and a bumper one this time around as well. There are a couple of IPOs that we need to watch out for this week. And first up, it's CAMS, then it is Chemcon, as well as Angel Broking. So you have new IPOs to look out for this week as well. Agri sector, the entire agri sector is in focus as government has passed the agri bills in Rajya Sabha. Remember that there was a ruckus over the passing of the bills in Rajya Sabha, but for now they have been passed. Both the all the three agri bills have been passed in Rajya Sabha. And let's shift focus on to the gaming area. And all right, let's take a look at what the markets are doing today. And it is a muted start for the brand new week. If you look at the benchmark indices, they're actually trading flat with a negative bias. And ditto it is with broader markets, but they are actually seeing deeper cuts compared to the benchmark indices. If you look at the sectoral indices, which are the ones that are gaining, most of the sectoral indices are actually down in red. You have Pharma, FMCG, Metal Index, all of them are down over 1% each. Even Auto and Realty is also lagging in trade today. The only one that's actually holding on in today's trading session is the IT sector. IT sector is up approximately 2% in trade. HCL Tech is the top mover on that particular front. But on that note, let me bring on board our guests for today. We have Kunal Bothra as well as Ashish Maheshwari joining us. Good morning, gentlemen. Kunal, I'll come first to you. And how are you looking at this current market scenario? And what are your high risk and low risk ideas for our viewers?
So good morning, Cheryl. And I believe that this week is likely going to be a bit choppy week for the markets, and purely because of the September expiry. I think some of the data points which transpired on Friday were I would say not encouraging as such for the indices, because there was good shedding of open interest. Now this comes as a bit of a surprise, because I think for the Nifty there was almost 3 or 4 days of consistent build-up of open interest, but on Friday, even after a late recovery for the indices, there was some open interest reduction on the Nifty. So almost I think a 12% or a 13% reduction in the open interest. Almost 18,000 contracts got reduced for Nifty, and I think around 3,500 or 3,700 contracts for the Bank Nifty as well. Now, when you're heading into an expiry weekend where you see reduction of contracts and reduction of rollovers, the expectation is that maybe the next series could probably be a muted series, and the start of the next series could be a bit choppy. So I think the markets are going in with that expectation, which is why I think today, in the first a couple of hours of market opening as well, we've seen some bit of mild choppiness coming into the indices. Now there are still a lot of I would say mid cap names in the I would say the broader market names which are still looking fairly attractive. So I would suggest two buy calls over here. Of course, one is high risk, the other is low risk. The high risk idea is the Bata India. The stock has been a severe underperformer in the 6 months of price recovery. But then when you look at the short-term chart patterns on the hourly time frame, there is a bullish flag and a pennant formation which is getting formed for Bata India stock prices, and that generally results into an upward breakout. So I'm anticipating the breakout on Bata India. Hence, I would probably place this on a high risk note and short-term targets of 1380, stop loss at 1320 levels. The second would be a low risk trade, and it will be a buy on Manappuram Finance. Now the stock has confirmed a breakout above its swing resistances. I think 160 was the previous swing breakout for Manappuram. The stock is trading above those levels, so which is why, since the stock has given a confirmation of a breakout already, I believe that it could probably be termed as a low risk trade. Stop loss could be kept at 159, which is just 1 rupee lower than the previous breakout level, and targets to be kept at 169 for Manappuram Finance.
All right, those are the calls coming in from Kunal, his high risk and low risk idea for today. So Bata India is the high risk idea that Kunal has for the viewers, and Manappuram Finance is the low risk idea. Ashish, good morning, and let's get your high risk and low risk ideas for the viewers today.
Yeah, my high risk idea is Tata Elxsi. If you see in last 1 month itself, the stock has given a return of almost 20% plus. But going forward also, I'm expecting this growth and return will continue. Again, the rationale are their broadcast and healthcare sector are driving growth. Second, with this Make in India initiative, etc., the kind of work they are doing in artificial intelligence as well as cloud computing and at middleware and hardware level where they are working from chip to semiconductor area, there's very high growth envisaged in next 1 year. Even in last quarter, we saw their net profit went up by from 48 crore corresponding quarter to 68 crore in spite of all the lockdown, etc. And there was significant improvement in net profit margin. So a Tata Group stock with just 8,000 market crore at present, in my view, this is going to be a multi-bagger over a period of time. But this is my high risk idea where you can get at least 200 rupees till this quarter number comes and later on. My low risk idea is HCL Technologies. In my view, this stock is going to get re-rated after this recent announced acquisition of Australian company DWS. This is going to be significant addition in their top line and bottom line. Also, their new tie-up with cloud with Google for the cloud, where they are going to shift their Avalanche platform there is again going to be getting more traction. Again, in fact, their revenue guidance of this particular quarter has changed the direction of IT stocks per se. So in my view, this is again a stock with very low risk, and it has a potential to give you another 100 rupees from here in very short period.
All right, those are the high risk and low risk ideas coming in from Ashish. Tata Elxsi is his high risk idea, while HCL Tech is the low risk idea. All right, let's get on board our viewer queries for today. Our first query is from Kishore Yadav from Jaipur, India. He's written to us saying that he's bought 300 shares of RBL Bank at 130 rupees per share and 200 shares of IndusInd Bank at 440 rupees per share. He wants to know whether he should hold or sell the counter. Kunal, I'll come first to you. RBL Bank, he's bought about 300 shares at 130 rupees per share. So what should our viewer currently do with RBL Bank per se? And then let's move on to what should he do with IndusInd Bank. His buying price is 440 rupees per share.
Well, I think first of all, I congratulate the viewer over here, because I think he's bought both the stocks, RBL Bank as well as IndusInd Bank, I think at almost the lowest end or the lower end of the price curves where these stocks were trading in the month of March and April. So I think quite brave decision from the viewer over here. And again, looking at the prospects of Bank Nifty, so I think the large part of the aspect of the answer would probably lie in the trends of Bank Nifty. So yes, Bank Nifty has been an underperforming sector overall for the last 5-6 months relative to the Nifty, and we've not seen major bull market I would say territories for Nifty when you have Bank Nifty severely underperforming like what we've seen today. But then on the other hand, there is of course a concern for the markets regarding what's actually going on for the banking sector. So I think in that regards, which is why banking stocks are underperforming. Now, to answer your question, I believe since you bought at much lower ends of, I think, 130-ish and 440-ish on, RBL Bank and IndusInd Bank respectively, I would sense, that since you have a lot of cushion, inbuilt over here, you should, look to wait on, both your investments over here, because if the eventual cycle for the markets would continue to move up higher, Bank Nifty sooner or later would probably try and participate once the bout of negative news flow, the expectations of negative news flow would abate. So purely based on the price decision and the price, your purchase price, I would suggest the viewer that you should hold on to your investments on both RBL Bank and IndusInd Bank, because when the Bank Nifty turns and when there is a reversal on the upside for Bank Nifty, then you would see a very strong and a vicious catch up happening into a lot of these private sector banks. So I think in that regard, you can continue to hold on to the investments on RBL Bank and IndusInd Bank.
All right, that's Kunal's take on RBL Bank as well as IndusInd Bank. He's saying that you should hold on to both the positions in the stock. He's saying that when the Nifty Bank will turn, you will see catch-up trade in most of these private sector banks. Ashish, what's your take on both RBL Bank and IndusInd Bank? Do you hold a similar view for both these counters?
I again hold the same view for both the counters. In my view, RBL you should hold till 200 rupees at least, because at 177 they recently raised almost 1600 crore rupees. Besides this, if I see their last quarter performance, it was also quite good as such, in spite of lockdown, etc. Only thing is their credit card portfolio, where moratorium, etc., is given, they are slightly sticky in nature. So because it's primarily retail and they are one of the major player in the credit card segment. So I think in short term there might be some pain for as far as RBL is concerned. But if you hold for 3 months, I'm sure 200 rupees you are going to get easily. As far as IndusInd Bank is concerned, I think whatever the concerns related to that bank was also there, they are also getting over. Only thing is the credit growth, which was driving these private sector banking stock, is not going to come soon, because there's a lot of risk aversion in the system as far as lending is concerned. So in my view, for time being, we have seen a very decent rally in IndusInd Bank, but still I'm expecting 650 rupees is the reasonable level on which you can exit from this particular bank. And again, this you may get in next quarter once the results are out. So my advice is for time being remain invested in both the counters.
All right, that's the take coming in from Ashish as well for RBL as well as IndusInd Bank. Let's shift focus now to our next viewer query, and this is from Rohan Gupta from Delhi. He's written to us saying that he's bought DRL last week with a 10% return, but he wants to know whether he should hold or sell the counter. Kunal, Dr. Reddy's has been a high flyer. It hit record high levels last week. Today it snapped that 4-day gaining streak. But what should our viewer do? Do you advise him to go ahead and sell the stock, or should he continue holding on to Dr. Reddy's? More room for it to go up ahead?
This is exactly and typically what happens when you see stock prices moving up on the back of some pick-up news flow. Now, you have to understand that whether Dr. Reddy's just started to move up higher after 6 months or 2 years or 3 years of price correction. If the answer is no, then I believe buying this stock at the peak of the news flow could be a bit of a tricky situation. So I would sense that the news flow is already out for Dr. Reddy. The volumes have already been, I would say, extremely high for the stock price in the last 3-4 days. So I think the volumes with the stock clocked on Friday was one of the best volumes the stock had ever seen. But the price action was also not at 4,500 levels. It was at 5,500 levels for Dr. Reddy. So the prices have already factored in. It's typically a low beta stock. So if you see those high flying price actions for in a short span of time, the stock tends to compress that kind of a time price action by going through prolonged bit of consolidation. So I would sense that if you bought Dr. Reddy, if you're already in the money, since I don't know your purchase price as such, but if you're already in the money, then I think you should definitely look to book out profits over here and then wait for significant level of correction. So and periods of sideways consolidation for Dr. Reddy to try and buy it back again. Rather than buying this on news flow, I think the idea should be to try and book profits on such kind of extreme news flow for stocks like Dr. Reddy.
All right, Ashish, what's your view on Dr. Reddy's? Given the news flow has been very positive for the particular counter, but do you think it makes sense to continue to hold on to the stock? Do you think fundamentally it makes sense to stay put with Dr. Reddy's, more room for it to go up going ahead?
See, in last 1 week itself, if I'll take today's high of 5,500, the stock has already given a 20% kind of return. And news related to Russian vaccine and Celgene claim settlement, etc., is already factored in the stock. So, in my view, those investors who have bought in 4,500, 4,700 levels, certainly they like to take some profit from the table. And this is what happening now in Dr. Reddy. Nothing wrong fundamentally with the company. Fundamentally, if you ask me, company will gain strength to strength in coming time. But in short term, my suggestion will be to book profit and exit once from this counter, and you can shift to stocks like Laurus Laboratories, which is again a dominant API player, or DB's Laboratories, where last quarter numbers were very good. So you can make more alpha there. So my suggestion will be to exit from Dr. Reddy at current price.
Exit from Dr. Reddy's at current price is the take coming in from Ashish Maheshwari, as well as Kunal also said makes sense to book profits if you've made money in Dr. Reddy's already. Let's shift focus now to our next viewer query. It's from Rohit Zaveri from Mumbai. He's written to us saying the best based on the tech rally in India Mart as well as Afril. He wants to know whether it makes sense to look at Route Mobile or CAMS, and also he wants to know whether the tech rally will sustain, or is it just another bubble? Kunal, what's your view on the tech rally? Do you see this as another bubble like our viewer is asking, or do you think this rally will sustain? And among Route Mobile and CAMS, which one do you think would be a better one? CAMS IPO is just kicking off. So Route Mobile saw a bumper listing today. So which one would you suggest?
Well, I'll answer the first half of the question, not the second half, because I am not an IPO expert. So I'll probably leave that difficult part for Ashish to answer. But I think on the first part, the reason why I think many of the investors and viewers and I think participants are probably expecting that there could be a bubble territory in the IT space is because there is a left out feeling. If you have invested into stocks like Wipro, HCL Tech, Infosys at those March, April lows, then I'm sure that the returns are extremely stellar. But then look at it in the manner that in the month of July is where we saw the breakout for the Nifty IT index. The month of August was a pause. In the month of September, again, you've seen many of these IT stocks rallying up by another 10, 15, 20%. HCL Tech is up 20%, Wipro is up 10, 12% higher in the month of September itself. And so is the case with many of these other large cap names. Now, if your question is towards large cap, IT stocks, I believe that there is a strong wave of upside which could be possible into these names. And when you see such kind of a price action, where you see the month of July and August, September particularly, that's probably an indication of what could transpire over the next few years. So my sense is that stick to the large cap names. I think there's still a lot of money which could be made in the large cap names purely on the IT stocks, IT space. And and probably if you have a time frame of more than 1 to 2 years, you may not probably have the similar kind of short-term returns what you can expect. Given the stock prices have already moved up in the last 3 months quite viciously. So the patience level should be extremely high. The strategy of buying has to be sorted out, where you are not buying the stocks on the thick of news flow. You're buying the stocks when there's ample amount of correction, and when there is less amount of news flow, and the stocks tend to lay a bit low. So I think that's the kind of time frame and time period where you want to try and collect the stocks and accumulate them. So I think I would probably be of the view that large cap, the longer term view for Nifty IT stocks, the Nifty IT space is extremely attractive. But from a short term view, I think there could be a bit of a tricky scenario because of the steep run these stocks have already seen.
All right, that is Kunal's view on the IT sector as per se. Ashish, what's your take on the IT sector rally? Do you think it will sustain? Looking at what India Mart and Apple have done, stellar rally coming in, and both these counters just got listed pretty soon, around a year or two or so. But does it make sense now to look at Route Mobile or CAMS? CAMS IPO is opening today, but Route Mobile listed today with a bumper listing. So does it make sense to look at these sort of counters in the IT space as well?
So first of all, let me answer first part of the question. Is it a IT bubble or this going to sustain? In my view, this is going to sustain. And again, the rationale is the way our lives are moving in this Corona times from moving physical to getting digital everything. So it gives a plenty of scope for companies now to go digital. And the major beneficiary of this digitalization program, which is not just in US, but every part of the world. In fact, our lives are also getting digital. Instead of cash, we are using so many platforms to make payments and ordering our things. So this is how your companies like India Mart, etc., tend to gain, because they are the one like which are selling almost 65 lakh plus products which are listed there, and they hold almost 70% market share. So there's no rocket science to know the kind of profit they are going to do in coming quarters. So market is ultimately chasing growth, and growth is coming in into IT and pharma. So this particular sector will continue to do well. As far as Root Mobile is concerned, again, they are leader in India as far as cloud communication is concerned, with all the marquee names from Facebook to LinkedIn to many others are ultimately their clients. So the growth momentum will continue in such stocks which are operating in a very niche area. Same thing is with the CAMS also. There's again registrar which is almost having 70% market share. So institutions typically like those stocks where there's no debt and consistent growth is there and no competition as such. So in my view, you should apply in CAMS IPO as well as Root Mobile as it got listed today. If you get in some correction at somewhere in 620, 630, you can accumulate it in longer run, because these kind of stories are going to be multi-bagger in next 1 to 2 years time.
All right, Ashish, thank you so much, for joining us today and helping our viewers out with their questions and queries. Well, of course, there's that important news that has come in with respect to HCL Tech as well. The blue-eyed boy is all set to acquire DWS Limited, which is a leading Australian IT company. We spoke to Swapan Johri from the company to understand the rationale behind the major acquisition and the path ahead for the company. Listen in.
Goes a little back in time. I think if you look at HCL overall over the few years, we've transitioned, and I would say not just transitioned, but we've, I think, quite stabilized into our new services mix. And very much in line with that, over the last few years, a couple of years in Australia and New Zealand, we've established our credentials both as a digital transformation services provider, as well as what we now call as a cost transformation services provider. I think the timing couldn't have been better, where we would be looking at how to expand our customer base and be able to take our capabilities, which are quite deep and quite of immense business value to our customers, to a larger set of customers. So that's been the driving rationale. If you look at DWS, they are a company that's spread across a large number of the most important verticals, I would say. I mean, so take the Australia IT services spend. It's in the order of $35 billion. And if you look at that spend, it is very disproportionately high in terms of the breakup between telecom, banking, and government. And this is exactly where DWS is present. So for us, it just helps us actually expand a base with the right streams of service, which is a lot of the digital transformation that is happening in the Australian market with Australia customers is a lot of capability that also comes in with this organization. Blend that with ours, and I think we have a very good combination. The EBIT impact is at a company level is nothing. So I don't think that's an issue at all. And if I look at the revenue expansion, I may not be able to share numbers per se, but as I just mentioned to you, the verticals where we can go to with a blended capability, the synergy value of working with DWS is extremely high. And so the 168 million is what they do currently across these verticals, with a very healthy split across, across these verticals. You would also notice in time, or maybe we can share it in time, that their customer base is quite different from ours at this point of time. In the sense, I don't mean in terms of verticals, but in terms of specific customer names. And then,
all right, well, HCL Tech is the big newsmaker of the day. Okay, moving on, let's bring on board our Chart Busters segment, and we have Kunal Bothra, as always, will be joining us for this segment. Kunal, what have you identified? Which are the candidates that are busting the charts today?
Mubina, I'm now picking up the major market, which I think all of us tracked, and that's Dow Jones Industrials Average. And there are some very interesting observations in line for Dow Jones Industrials Average. So if you can see the charts over here, there are three head and shoulder patterns which are getting formed for Dow Jones, and on the stock prices from the March rally or from the March recovery. These are something very, very important to take note of. So Dow Jones is forming a third head and shoulder pattern, and two times when the index had formed the head and shoulder pattern, it did not break below that pattern, which is typically a reversal indicator. So head and shoulder patterns are typically reversal patterns. So if they break, you expect a downtrend to ensue into the indices. But on the previous two attempts, which has been marked on the shaded region, the Dow Jones actually did not break above its above or rather below its the head and shoulder pattern, and which is why the index tend to rally. Now the head of the previous pattern actually became a support for the next head and shoulder pattern to form, and we've seen those confirmation twice on Dow Jones happening. So if you can see the resistance line, which changes its behavior to support line whenever you see a breakout. Now we are at the third time for the Dow Jones, which is heading towards this head and shoulder pattern. Whether it's the third time lucky or not, I think only the time will tell. But probably if Dow Jones breaks below this 27,000 mark, then I believe that there could be a strong indicator of a reversal on the Dow Jones, and that could probably put pressure on a lot of the equity markets across the globe. And if we hold on to this head and shoulder pattern and we don't break below it, then probably third time lucky for Dow Jones, and possibility of a continuation of uptrend is pretty much high.
All right, so Dow Jones, it is that Kunal is identifying. Thank you so much, Kunal, as always, for joining us today on the show. Well, we do one thing. We will slip into a very short break right here on Buy Now.
Welcome back. You're watching Buy Now, Sell on ET Now with me, Cheryl, as well as Varun. Varun, let's talk about Root Mobile IPO. Last week we had Happiest Minds doubled on exchanges on the listing day, and ditto is the case with Root Mobile. So it's listed with 105% premium to the issue price. Tell us more about this particular company. What does it do, and also how did it list on the exchanges?
Sure, Cheryl. So it's a very exciting company. You have to compare this to two companies abroad, one in the US called Twilio, which has a $33 billion market cap. The other one is Cinch AB. Now, what they essentially do is provide the OTPs for our banking messages. So HDFC Bank is a customer, Bank of Baroda is a customer. They have the largest Bank of America as their customer. They also do two-factor authentication. So sometimes on Facebook and Google, when we log in and we don't want to put our password, so we ask for an OTP to come to our mobile phone instead. Very small percentage of people opt for this option, but a guy like Root Mobile can do this for you. So here's the main drivers of his business. He's migrating to higher margin business. He's listed at 100% premium nearly. So Happiest Minds was 111% premium to issue price. This is also around that same ballpark, 350 issue price. We're currently at 675. So it's been a great listing. I'm sure we'll be catching up with the management at ET now very soon. But it's a tech company, and these tech stock, we all know the valuations have been going up as the NASDAQ also goes up. So very exciting company, and in time, we'll tell how the performance really speaks. But as of now, in the last 5 years, the growth rates have just been tremendous, which is also why you're seeing such a high valuation.
All right, and that is Route Mobile for you, and you can catch the management on ET now at 12:05 p.m. Let's shift focus now and let's talk about IPO, and it's going to be a very busy week for the IPO street. And after the listing of Happiest Minds and Route Mobile, now all eyes are set on CAMS, Chemcon as well as Angel Broking on their IPOs. Vivek is here to take us through on the busy week on the IPO street.
Well, two significantly large IPOs will be hitting the bourses today, and you're talking about CAMS IPO, you're talking about this particular infrastructure developer. Now remember, CAMS is a technology-driven financial infrastructure and service provider. It is India's largest registrar and transfer agent as far as mutual funds are concerned. Significant amount of investor interest could be expected from this particular IPO. The IPO starts today and ends on September 23rd. The issue size is over 1.8 crore shares, which aggregates to a little over 2,200 crore rupees. Now remember, there is no fresh issue of shares. It is mainly an OFS and exit for existing shareholders. The expected listing as far as this particular stock is concerned is on October 1st, 2020, and the IPO price would be close to 12.29 to 12.30 rupees a share. It has almost 69.4, almost 70% share as far as the mutual fund aggregate universe is concerned. So I expect this particular IPO to be to have significant amount of investor interest as well. On the other hand, another company that would be listing today is actually Chemcon. Now you're talking about Chemcon IPO. Again, this particular stock, remember what's actually happening as far as the entire chemical, pharma, agrochem space is significant amount of investor traction. Ambit is the book running lead manager for this particular IPO. The company is a manufacturer of specialized chemical products. Portfolio includes mainly oil field chemicals. It's present in the CRAM segment as well as a leader as far as pharmaceutical chemicals is concerned. Which are the company's key customers? Hetero Labs, Loris Labs, Aurobindo, Lantec as well as Macloids. All of these are significant partners or significant clients as far as this particular company is concerned. The IPO begins today, ends on September 23rd. Issue size of close to 93.5 lakh shares. It is a mix of both fresh issue as well as offer for sale. A fresh issue of close to 165 crores, while an offer for sale of close to a little over 150 crore. The IPO price is between 338 to 340 rupees per share, and expect this particular company to list at the start of October. Significant IPOs hitting the bourses, so it'll be interesting to see what kind of response they manage to garner.
Well, as Vivek just pointed out, it's raining IPOs. Come tomorrow, it's India's top brokerage player, or at least one of them, Angel Broking, all set to list. Price band has been fixed at 305 to 306 rupees per share. The company plans to raise 600 crores, 300 via an OFS, and then 300 fresh issue. We caught up, though, with the management of this firm to understand what the future prospects are and exactly what the proceeds of the issue will be. Listen in.
We are planning to raise 600 crores, 300 would be primary, and 300 would be offer for sale. And this capital will be utilized for working capital requirement. See, if you look at growth of this industry, it would be wrong to say this growth has come just in this quarter. Agreed, there are some tailwinds, but this cannot be quantified as a very strong tailwind which has changed the growth of this industry. If you look at this industry for past 5 or 6 quarters, we were seeing a good growth rate in terms of customer acquisition. So I believe that this growth rate, what we are seeing, it is not dependent on lockdown or on COVID. It is just a structural story which is playing out. It is because of inflation in control, because of lots of macro economic parameters. There are lots of people who are first timers and they want in terms of getting jobs and have started saving. They don't have an alternative to put into kind of a risk-free asset like FD and get and earn a 9 to 10% return. So this generation has to take some exposure in equity if they want to get a good returns. So that is what is panning out. India is young. So this young millennials, when they get their first job, when they're planning their first saving, they're exploring ways and possibilities to get better returns on their saving. That is what a story is playing out.
While you have your IT sector and the pharma sector that have been great outperformers in the market, the Nifty Bank has been a clear laggard in the market with the third straight week of underperformance. It closed at the lowest level in a month on Friday, has declined over 7% so far this month. So what are the charts actually indicating for Nifty Bank? Jayesh is here with the ET Now Inside. Jayesh.
There are two charts which are suggesting that the Nifty Bank could be at important levels to watch out for. One is the ratio analysis with the Nifty. If you have a look at the Nifty Bank to Nifty ratio, that is currently trading at 1.91 levels. Now, what's the significance of this is, that this was the level that it touched in May 2020, after which the Nifty Bank had an intermediate low formation, and from there on it bounced smartly. And interestingly, if you track back in history, the global financial crisis, 1.89 was the level from which it actually topped out, and post that we had a smart rally in the banking stocks as well. So this is an important level that we are tracking in terms of ratio analysis. The other one that I'm tracking is on the weekly charts. The Nifty Bank has formed a death cross formation, which is the 50-week moving average has crossed below the 200-week moving average. This is only the second instance in history that we've had such a formation, the earlier one being in 2007-8. And interestingly, the Nifty Bank after such a formation had in fact bottomed out, from where it rallied smartly as well. Now, what are the internals suggesting for the Nifty Bank? Of course, it's on the negative side because we have seen massive underperformance from the banking stocks. But all stocks of the Nifty Bank have declined so far. All constituents of the Nifty Bank are trading below their target price as per analysts, except for one, which is PNB. And interestingly, 9 out of the 12 banking stocks are trading below their 50 and 200-day moving average.
Okay, those were some very interesting insights by Jayesh. But on that note, let's slip into a quick break here. Plenty lined up when we come back. Hello, welcome back to Buy Now, Sell Now. As part of our new initiative, we have another quiz question that needs to be addressed today. And our question to our viewers was, which one of the following listings has received the highest retail subscription for their IPO? The options were Rosari Biotech, Root Mobile, Happiest Minds, and SBI Card. Now, as many of you have correctly guessed, it's not a very difficult question, but the retail portion is where Happiest Minds really stood out, apart from the overall as well, being over 70 times oversubscribed on the retail portion. So that was our winner for today, Happiest Minds Technologies. And we have 3 guys who have tweeted us the right answer. We have Pradeep Kumar, we have Arun KC, and we have Minara Simarao, who've all guessed the correct answers. Congratulations to you, and we thank you for your participation, and we hope that you continue participating in the days to come. With that being said, let's get a move on. The quiz is out of the way. We have some interesting excerpts lined up for you. Earlier in the day, we had caught up with S. Narain of ICICI Pru AMC, who mentioned that we are in a developed world, the central bank-led bull market. He also said that ESG is an excellent tool for long-term investment. Here's a slice of that conversation.
The reality is that we are in a developed world central bank bull market, and you have to recognize that we are in a 0% interest rate environment. And in a 0% interest rate environment, there are a lot of things which become very interesting in the Western world. Because if the Fed chair comes and tells you for the next 3 years, I'm going to keep interest rates at 0, there are certain things which do become very different from what it is before. So I think the world is also adjusting itself to a developed world central bank bull market. And even in India, we have seen one of the lowest interest rates on short-term rates ever that we have seen in my investing career. So I think we have to recognize that we are in a developed world central bank bull market. And what is interesting is we have spent a lot of time trying to think of what do you do in a developed world central bank bull market. We think there is a requirement to be in equity. We believe there is a requirement to follow asset allocation. We believe there's a requirement to have some position in gold. We believe there's a requirement to invest in debt. We believe there's a requirement to invest a certain amount of money in global markets. And we believe that it is not wise to say today is the day to make your equity zero. And I think these are the things that we learned out of repeated discussions on what is a developed world central bank bull market means. Because while you may have a US presidential election, developed world central banks don't have to face elections. They don't have to go through a situation where if I underperform for a few months, my money will be taken out. So these kind of things don't happen. And that's why I think we went through a lot of discussion to arrive at these views. And I think global gurus are also learning that there is zero interest rate with credit spreads being so low is something that they have also seen in such an extreme way for the first time. So you have to also give it to them. And you have to also remember that many of these investments like Warren Buffett and Apple, they were not made.
And as a part of a special show, the Victory Project, 6 Steps to Peak Potential, we covered with Saurav Mukherjee of Marcellus and Jason Voss. They explain how to excel not only in markets, but also give life mantras listening.
I've been privileged to meet several great investors. I don't put myself in the category of great investor. I consider myself good. And they include Warren Buffett and the gentleman who founded the firm I used to work at, Shelby Davis. And what I know about them is both of them have the ability, like Delio, probably Saurabh in his burgeoning career, to access these meditative states that we've been talking about during this interview. And they are, exactly as Saurabh describes, able to simplify many things, not just a description of what they're doing in order so it's better communicated, so it spawns new investment styles. If they look at vast amounts of data, they are able to pick out the salient reading on the data. They're able to contextualize that understanding to tease out the insights that nobody else is seeing. And in fact, the reason I wrote The Intuitive Investor was because of a story about Warren Buffett, where one of the folks that worked at the firm I used to work at was sitting by Buffett at the very moment that an annual report came in, and Buffett was thumbing through the annual report, and he looked at a table, and within the table he saw something that triggered his intuition, for lack of a better description, and immediately executed a sale order based on that single number. And if you know Warren Buffett's history, he doesn't do that often. And literally hundreds of other investors digested that same information, but he saw something meaningful in there. And I knew that what he was doing was simplification, right? So here's an entire annual report. One piece of data led to him abandoning a stock, and he's famous for long-term investing. Similarly, the gentleman who used to head my firm, Shelby Davis, had that similar gift of being able to know what was salient. He could listen to an entire
Nifty 50 ETF AUM crosses a 1 lakh crore rupee mark to celebrate the big feat and to further explore the opportunity in the ETF for individual investors. Today on ET Now, we would be speaking to Mukesh Agarwal, the CEO of the NSE Indices. Catch this exclusive interview at 5 p.m. right here on ET Now. One interview that you would not want to miss in this evening. And with that, we are out of time on this edition of Buy Now, Sell Now. Stay tuned to ET Now for more news and updates.